So on prior live streams, we've been talking about companies that have buyback programs in place, and one of the stocks that we've talked about is Howmet Aerospace. And net of Boeing's troubles, I thought we might want to take another look at that one, and we will so today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. Thank you for waiting. We had a power outage. Hopefully that does not recur at a critical part of the production process. So basically what I do gets streamed to one place and then it goes back out to everybody else. And that is the spot where the power outage took place. Anyway, and I'm trying to remember who brought up Howmet in particular. So that's ticker HWM for those of you who don't know. Let's just talk a little bit about Howmet for people who are unfamiliar. So the company is going to be reporting earnings on November 6th. Howmet Aerospace is a supplier to, as the name would suggest, the aerospace industry. They do some other things too. They make Class 8 truck wheels, among other things. And even within the aerospace area, they have different segments. So aluminum, titanium pieces, fasteners, and critical jet engine parts. So last week, as many will know, Boeing announced that they were going to be laying off 10% of their workforce, 17,000 employees, that they were going to do an equity raise. And of course, anybody who's been following the company knows that it has just been a long list of challenges for Boeing. Some of them self-inflicted, it should be said. So obviously everyone's well aware of the issues that took place with the 737 MAX, but they have had ongoing challenges with the 787 program, the 777X, which is their largest aircraft now that the 747 is out of production. They are delayed now due to cracks near where the engines mount to the aircraft. And I guess they identified that on one of the test aircraft, and then some x-rays or other work that they did on some of the other planes illustrated that those also had the problem. So that's delaying production for the 777. So let's talk a little bit about Howmet first. So on my screen, and we can have this up on the side, I happen to have a price chart of Howmet versus SPY and XLI, the industrials ETF. And you can see in the upper left, hopefully, maybe you can, or maybe not, so I'll read it to you. Over the last 5 years, the total return for Howmet is about 364% versus 113 and change for SPY, so that's price change plus dividends, and about 97% for XLI. So vast outperformance. Some of that outperformance is due to the company's own fundamental performance. So just to put some things in perspective, just throw a couple digits on what we're talking about here. Their Q2 earnings results, they had a 14% year-on-year increase in revenues. They had a 31% increase in adjusted EBITDA. Their EBITDA margin went up by 340 basis points, and their adjusted operating income margin was up by 370 basis points. Net of all that, their adjusted earnings per share were up 52% year on year. And of course, when you see those kinds of numbers, then you would expect that you get a pretty good multiple, pretty good turn on those numbers. And indeed, that's exactly what Howmet does have. So this is a company that, for a long time, traded probably at or even below an S&P market multiple. And then only within the last 5 years or so have we really seen these multiples take off. So if you're looking at my chart right now, I'm going to get rid of the price here. And of course, you might want to ignore this big mountain in the middle of the chart, because that's taking place during the pandemic, sort of threw off earnings and a lot of other things for many companies, including this one. But what we're really looking at here is, price to earnings, if we want to, pre-pandemic period. So we can see that just before the pandemic plunge, it was actually trading at a relative high compared to its own recent history at around 21 times. And it's trading at 44 times now. We can pick another multiple if we want. Look at price to sales over the same time. Let's look at price to free cash flow. There was no free cash flow over here, so that kind of threw it off, but maybe I'll shorten this list up to just go back over here. So that's a shorter window, maybe to EBITDA or something like that. It's a similar refrain no matter what you're looking at. The multiples on this thing have just expanded tremendously on the back of their better operating results. So with that, I wanted to just read you some of the comments that came from the company's CEO on the last conference call. So John Plant is the current CEO. He came from Masco. He was the co-CEO, I believe, when he signed that contract back in 2020, but I think he's the CEO exclusively now. And he made this comment when he was being asked about margins. And he said, aerospace is a cyclical industry, and anybody who has the absolute knowledge, and according to the transcript it says precedence, but I'm assuming it meant prescience, to know exactly what volumes will be next year and the year after and the year after that, and what the rate of increase will be, something I don't have, and therefore I've never been comfortable talking about. What I think margin rates will be in the future. I think all we can do is to say, this is what we're doing, these are the changes we're trying to make to improve our company, and I don't follow false ground of whatever happened over a decade ago at one company, whether those were real or not real margins at the time. He goes on a little bit like that. But the operative part of his comment here was related to the fact that this is a cyclical business. Now let's just talk about some of the cycles that we're in, long-term and short, and some of the places where they are actually in a good spot. So they don't like to discuss their market share, but one of the reasons that the margins improved in that quarter was because their product mix shifted increasingly towards jet engine components. This is a higher margin business for them. It is an area where they have been growing. It is an area where they're making a significant investment. In fact, they mentioned on that last conference call that they were increasing CapEx to about $320 million, and they were going to be, building a new plant and doing a lot of work to automate that and using some advanced technologies. And without giving up exactly what the market share was, they pointed out that they were gaining market share in that area. Here's the thing, though, and that is that the sales rates for the company are consistent with higher production rates than the airline manufacturers have actually been achieving. Now, you can have situations where there are inventory imbalances, or they're trying to build inventory or spares, things like that. But the fact is that it's hard for me to see how Boeing is going to hit any production targets that they had previously had for the upcoming 18 to 24 months, as they're doing such massive headcount reductions and as they're encountering other types of production snafus. I think Airbus also brought down their production estimates by a couple units per month as well. Now, bear in mind that with some of these big aircraft, 8 aircraft a month, 9 aircraft a month, these things all make a very big difference. They don't roll off the assembly line like cars do. And so I bring all of this up because with these more elevated valuations having come so far so fast, it does make me wonder whether the company could, we're talking about aerospace, hit some headwinds when they report earnings on November 6th. And part of the reason that I say that is because the question they are almost undoubtedly going to get many times over is, how are the problems at Boeing affecting your business. And the reason I know that's going to be the case is because about half of the last month's conference call was dedicated to Boeing's challenges. I think if you look at the transcript, it got something like 12 mentions. It was a very hot topic. And now that the news has only gotten worse at Boeing, I'm going to imagine that it's going to be an even hotter topic. And at some point, someone is probably going to say, maybe we reduce our estimates. Now, I think for their 737 delivery estimates, Howmet had said that they were going to be conservative, and they actually bumped it up from something like 20 a month to 22. Again, that doesn't strike me as being hugely conservative. I want to point out, though, that I don't get the feeling that Howmet's management does anything but shoot straight, if you will. In other words, they're trying to give you the real story. They're not trying to butter up the street or investors or anybody else with promises that they think actually, talking about things like margins and share, where they actually think that has challenges that could be in their business. They avoid talking about it. So in any case, my thinking is that it may make some sense to, if you hold the stock, obviously, especially if you've held it for the last 5 years, good for you. It's been a huge win. And I know that at least one or two of you have, because it has come up. Oh, one other quick thing I wanted to point out, because it was in the context of buybacks. So in July, they had a $2 billion authorization, incremental authorization for buybacks. But their second quarter buyback pace was about 60 million shares. $60 million worth of stock. So the $2 billion is about 4.7% of the float at current market prices. But the pace that they've been deploying the capital available for buybacks isn't quite as big as you might otherwise think. So, they have a modest dividend. I think they're paying 8 cents a share, so that's 32 cents a share on a $100 stock is 32 basis points. Their buyback pace is probably 3 times as big, and it'll probably accelerate now that it's a little bit bigger. But one way to think about that is how much cash is being returned to shareholders, either in the form of direct distributions, in the form of dividends, or in the form of stock buybacks. And if you're getting 32 bips a year in dividend payments, and maybe you're going to get 3-4 times that amount in buybacks, it's not quite as big as the 4.7 that buyback looks like it is, right? Because they're not really on pace to deploy all of that over, say, the course of the next 12 months. So where that leaves us is, with the elevated valuations, just knowing that people are going to be asking the question, who else could be affected by what's going on at Boeing, they're going to show up on the radar. Because 5.6% of their company's revenues come from Boeing, but a greater percentage comes from GE and Rolls-Royce, engine makers, which are suppliers to Boeing. So that's indirect. And then maybe 4.6% or so from Airbus. But you get my point, that that could potentially create a headwind. So a way to potentially play it, we'll just do this here, so that you're managing to capture all of the stuff that's going on. The options market was implying a move of about 9, when I was looking at this earlier, a little over 9% by November expiration. So after the November 6th earnings, I just figured let's just round it up, call it 10. The stock was around $1.0250, maybe a little bit more. 10% down is 92.5. So I'm kind of taking a look at the implied move to do my strike selection, right? Gets us to 92.5, and this would be a put calendar, and you could pay $287 for a Nov April 92.5 put calendar. So you're looking at something that costs, about 2.75% of the current stock price or thereabouts, to make a bet that would, profit either on a standalone basis and would see peak profits if the stock fell about 10% going into November expiration, which is going to capture both the election, of course, which we've been talking about a lot, and this upcoming earnings. And, I will make one other quick point. It's not my habit. Fundamentals are not a timing tool per se. So I'm not suggesting that you want to sell this thing because it's trading 46 times earnings, even if that is a peak valuation or very close to it over the course of the last 5, 7, 10 years or whatever. Besides which, with 52% year-on-year adjusted EPS growth, a multiple like that wouldn't necessarily be so terrible. What I'm saying is that the market overall is at headier valuations. This is at valuations that are high relative to itself, and they are affected by their biggest customers. And their biggest customers include Boeing, and Boeing is having some problems. So that's sort of laying it all out, because usually what I would like to see, and I brought up this one page, I don't know if you can make it out here, most of the technical indicators are still positive. Obviously, it was weak today, but it was interesting because I was writing this whole thing up over the weekend, and it hit an all-time high last Friday. And I was thinking, I'm not top ticking this thing. I mean, never top tick anything, never bottom tick anything. I have no idea where those levels lie. But it does seem like there are a couple things lining up that are not in the company's favor right now, and thus I'm considering this calendar put spread. So I wanted to make that point because we had talked about it in the context of the buyback conversation, and because I actually reiterated a buy on the stock, I think it was only about a week ago, and it was just after all of the news started coming out about Boeing and the 17,000 layoffs that I decided to take another look at it. And sometimes that's what it takes. You have the bull case, the bear case, and your own case. And the bull and bear case haven't necessarily changed a whole lot, but where I land on that spectrum has changed a little bit as I've given it some more thought, and I didn't want to wait before telling all of you that. Okay, so with that, I'm going to start taking some questions. Monday morning quarterback. You mentioned concerns about a rising market and a rising VIX as troublesome. Your thoughts as the VIX stays elevated as we make new highs? Yes. So I brought this up prior, and that is that, at least in my professional career, one of the things that stood out to me most notably in the first real bear market that I encountered. So relatively new to the business, I joined the business in the mid-late 90s. And of course, that meant that I watched the market take off in the late 90s in the tech bubble. I remember Alan Greenspan talking about irrational exuberance in testimony before Congress. I believe that was in 96. And only to see the market continue much higher. And of course, there was some irony in that, as everyone said, party like it's 1999. And indeed they did. We had a lot of stocks that got to levels that were very hard to explain on any fundamentals. And in many cases, the companies had no fundamentals. There were a lot of companies like the Pets.com era companies that had gone public that really didn't have any profits at all. Cisco was a real company. That was probably the biggest poster child of its era. But, the valuation, I'm trying to remember, it was something like 200 times. Or it was a really quite an incredible valuation. What I was referring to is that as that happened, generally speaking, one of the things we often see is that a steadily rising market, you see relatively compressed levels of volatility. And, that indicates that investors are complacent. And it's interesting, you go through these cycles and relatively low volatility periods can last for quite extended periods of time. We definitely saw that in 2017. We saw that in parts of 2007. And one of the things we also saw, though, was that in 1999, as tech stocks were starting to get closer and closer to what proved to be their zenith of the time, a level that didn't get touched again until only just recently, was that the market started to become more volatile as the market rose rather than less so. Or rather than, at the very least, sort of maintaining some relatively quiet level. Now, I have a theory about why that is, and that is that if an increasing percentage of investors believe that the market's due for a correction, that stock prices are overvalued, that geopolitical events could cause some turmoil. In short, that more and more investors come to believe that there's risk to equity prices. That would help explain why they become more volatile even as stock prices rise. Also, I would point out that there's a fundamental reason which rarely gets discussed about the relationship between stock prices and the volatility of those stock prices. And I'm going to pull up the balance sheet of AT&T, which one of our producers is actually, it's one of his core holdings. I'll just point that out. This is not a knock on you, Brad, but it's just a point that I want to make. And that is that some companies, including AT&T, have significant levels of debt. And this has a functional relationship on how volatile the equity might be when it declines relative to when it increases. It can help explain why we see this skewness. Why is equity more volatile? Well, people will often say stock prices take the stairs up and the elevator down. They climb a wall of worry and fall off a cliff. Whatever, metaphor, analogy, whatever it is you want to use. One of the things that is definitely true is that if a heavily levered balance sheet, if that stock declines, then all else equal, the volatility of the equity should go up. And this will make the analogy I always like to use that I think makes it very easy to understand is that the equity of a house that is fully mortgaged, so you have 80% loan to value on a mortgage, the volatility of that 20% of equity is going to be greater than for the exact same house with no mortgage. And the way to think about that is that if you have $1 million house, $200,000 in equity, $800,000 mortgage, and it changes in value by 10%, the value of the equity is going to change by 50%. If it goes up by 10%, your $200,000 in equity is going to become $300,000. And if it goes down by 10%, your $200,000 in equity is going to go down to $100,000. So leverage impacts equity volatility in this way. And that's one of the reasons why, in general, for companies that carry net debt, you will often see that volatility will rise when prices are lower and will go lower as prices are higher. On the other hand, the opposite would also be true if you have companies that have net cash on the balance sheet. So the biggest companies out there, let's take a look at those, right? So NVIDIA, if the valuation is high, and in this case they've only got about $25,000 in net cash, but there's no sort of net benefit that's going to take place for them as it rises. Apple, another one. So I'm just taking a look at the biggest constituents, but we could sort of think of these as proxies. So we've got $50 billion in net cash there. So the beneficial effect of that net cash diminishes as the valuations increase. And that's typically going to happen when valuations are extended. And, my friend and colleague, co-author of the Options Edge book that we published by Wiley back in 2016. He's now a professor at Rutgers, Mark Guthner. He posted, for anybody who doesn't follow him on Twitter, he posted a little talk that was being given by Howard Marks on risk. He made a video about it relatively recently. Howard Marks, for those who don't know, he was a former TCW guy. He founded Oaktree, which is a really big asset manager in Southern California. I believe he now lives in New York. He actually is the one that backed Jeff Gundlach, who is also a TCW guy, and then had a falling out with the company and started DoubleLine. And one of the things he pointed out was that somewhat counterintuitively, to some at least, is that risk goes up can go up as prices go up. And the point he makes, and I'm trying to remember exactly what he said, but it was something to the effect that, you know, if you pay a low enough price for something, the risk is commensurately low, because that's the most you can lose. So as prices rise, risks rise. If perceptions of risks rise, then you might expect to see increases in volatility. So all of this does concern me a little bit. And so I just wanted to, so just staying on that one theme, I think that's an important thing to remember. And because of it, you know, I previously said, you know, you want to own some probably put spreads going through the election. We had talked about that before. And you know what, why don't we just come up with one right now while we're at it for anybody who wasn't watching then, but is interested. Actually, on this other page, I happen to have a presentation from Howmet's last earnings call, which is kind of interesting. If you want, it's available online. So I encourage people to, you know, and whenever you're looking at these companies, investor relations websites can be a great resource because they keep all of the transcripts and things like that around. And I like to just keep the transcript up on one screen, presentation up on another, and then I run the audio for so rather than listening to the earnings call in real time, and besides which you can't do that, since so many companies tend to report earnings around the same time, you can't listen to every call concurrently. So I like to go back when I happen to be looking at a company, take a look at some of the numbers, listen to the call. But the nice thing is that if you're listening to it on playback, you can speed it up a little, which I often do. So, you know, put it up to 2x for the intros when they're giving all of that boilerplate nonsense where they tell you about forward-looking statements, and about 1.5 times for the rest of the call. So yeah, there is that. But let's just take a quick peek here. We'll use SPY. I think it's as good an example as any other. But if you want to hedge, I was in my previous example just looking out past November, and I was looking for any kind of a put spread that might get me, you know, better than the 3-to-1 payoff that you often look for on these debit spreads. And usually with SPY put spreads, it's not terribly difficult to get that. So you're going to be looking at getting, you know, something like a 30 delta spread. We'll go like this. Let's see what we have here. I don't remember exactly which one I was looking at, but it could have been something like this. So here you have a $20 put spread, spending $4 and change for it, and you know that math basically, that pretty much gets you there, very, very close anyway. Okay, so there we are. All right. Good morning, Mike. Happy to get another earnings season underway. They're probably my most active trading names of the year. United Health and Goldman Sachs entered today. Yeah, so if anybody who has heard me speak about it probably knows that I'm a big fan of the company United Health, certainly one of the best growers over the course of time. I'm a little... I can't say I'm completely impartial on United Health, and I've disclosed this before. When I worked at CRT Capital, our head of research was a woman by the name of Cheryl Skolnick. I had a tremendous amount of respect for Cheryl. And as it happens, United Health was, for all of that time, probably her most favored name in this space, and not by a little. And as it happens, she's gone on and joined the company. I think she's actually been a senior executive now at United Health for like 5 years or so. But obviously a phenomenal growth story. You're mentioning that it's a recent ad, I guess, on these highs. I give you some kudos for that, but it is, you know, a stable and growing business, and you know, pullbacks in this thing have almost always proven to be good points to enter it. I mean, look, it's a growing industry. They manage it as well as anybody. So, yeah, that's fine. Goldman Sachs, I also kind of like this one. So, I was talking about this last week on Fast Money. Goldman Sachs, Morgan Stanley, both going to be reporting earnings. Morgan Stanley, it's going to be a little bit easier to kind of forecast what their revenue picture is going to look like because they have, where they used to be kind of head-to-head with Goldman Sachs on the investment banking side. Under Gorman, the company's former CEO, they really were focusing on asset management at Morgan Stanley, that is. Actually, Gorman, let's see, he's now so James Gorman's now just the board chairman, but it's now Ted Pick, who's the CEO over there. But as they pivoted towards asset management, one of the things you can do is kind of back out how they're doing as a business simply by taking a look at asset prices. As asset prices go up, they get a percentage of AUM that basically dictates their revenues. So that's positive for them. The same is going to be true for, I think I saw somebody else mention Blackstone in here. Oh yeah, John Smith. So somebody else is talking about, so there we are. So Blackstone also got to mention, a little bit different there. I was, if you were looking at BlackRock, then they're going to behave a lot more like Morgan Stanley. Blackstone, it's a little bit different on the private equity side, but again, all of these guys have tailwinds for as long as asset prices are going up. And the biggest knock for the private equity guys, so I'm going to pull that question up as well because I think these things are related, have been rates, right? Because these tend to be more levered plays, but and rates, 10-year rates have started to tick up a little bit lately. For what it's worth. But yeah, I expect these guys to all do well. And here's something else, right? So these companies, in many cases, are really, they're pretty cheap compared to the market. In Goldman's case, a lot of folks are forecasting an uptick in the IPO business. That's the primary market. When we think about investment banking, that's what we're talking about, right? It's things like that. Is stock and bond issuance, sort of their bread and butter business, as opposed to asset management, more as I was just pointing out on the Morgan Stanley side, and C&I loans, which we can look to. J.P. Morgan does a lot of investment banking business as well, but and I do think, by the way, I would rather. I'm broadening the conversation a little bit by saying this, but if I was going to look at the money center banks, I tend to favor JP Morgan, even though it trades rich to the group, whether you're looking at price to tangible book or any other multiple. But all of these things are still looking relatively cheap. The reason I favor them specifically is that some of these banks have not done such an exceptional job managing their duration risk. And in the case of Bank of America in particular, so it's this line right here that worries me. I don't know if you can see that very well. Where do I blow this screen up? But it's this. It's the held to maturity. So I'm sure most of you guys already know this, guys and gals already know this, but the held to maturity securities are ones that are not marked to market. And this is essentially how a lot of the banks that blew up, this is how they managed to do it, was that they loaded their balance sheets with a lot of duration, and then rates took off, and long-term treasuries got cut in half. And even though they don't have to realize that loss, the banks were effectively insolvent as a result. The held to maturity book, which was amortized over time, instead of being marked to market, if you did mark it to market, they would see significant losses. And Bank of America accumulated a significant amount of mid-long-term treasury debt. And that, I think, was a little bit of a problem for them. And I think it may have been Jamie Dimon himself who said, I don't know how they did that. It just incredulous, I guess. Not that, you know. Anyway, I think there is some risk on the rate side, and I wouldn't want to have any piece of that. Okay, so yeah, Blackstone, Goldman, Morgan, JP Morgan on the financial side, those are the ones that I like. Bank of America maybe a little bit less so, just because I think it's not as well managed. Now, a big holder of Bank of America, for what it's worth, was Berkshire. So a lot of people would look to it and say, oh, well, this is the one that Warren Buffett likes. Well, yeah, yes and no. So don't forget that his investment in Bank of America came in the form of some converts and warrants. You know, he was contributing a lot of capital to distressed financial institutions coming out of the GFC. Goldman too, by the way. They bought theirs back though. Something he had hoped wouldn't happen, but they were, you know, these guys were paying him big preferred dividends, and so they understand that the Berkshire crowd are very opportunistic investors. They typically maintain massive amounts of cash, and when things really hit the fan, they step in and they get a deal that nobody else can. So when you go and you take a look at their holdings, bear in mind, you know, read the fine print. Oftentimes they have very, very favorable investments that they've been making, and such was the case here in the case of Bank of America. And I think they've actually been reducing their holdings in it more recently. Let's just double check that though. Yeah, okay. Think they've been reducing it. Yeah, you think? 260 million shares. They still 260 million shares of it. So reducing it, yes. I think it's safe to say. Corey is asking Uber strangle swap into earnings and when to put it on a week before. Yeah. So in general, I like strangle swaps. The thing you're looking for is just to make sure that the premium you're selling justifies that action. So right now, according to Bloomberg at least, the implied move is, 6.6%, averaged about 6.8%. Over the long term, probably a little bit less over the most recent 8 reported quarters. And don't forget that what I said before, the implied move is calculated off of a differential between the implied volatility of two options that capture the event. And because we have the election, we really have 3 events. So the longer dated options are going to capture, the earnings and the election and the subsequent earnings. So that's going to bump up the longer dated implied volatility a little bit. And the net effect, if you're using something that does an implied volatility calculation, is that the implied vol for the event may look lower than it actually is. So to me, 6.6% seems reasonable. I think, you can probably put this on or about earnings. So you could do that, Monday, Tuesday, Wednesday. So you could do it a little bit before. Sometimes, by the way, I don't mind putting these things on a little bit early. As much as even now I might put it on, 10 to 14 days early. There's other potential catalysts for some stocks. In Uber's case, it's not quite so much. What their closest comp is going to be something like Lyft. But yeah, just a point, something to think about there. You could do that. So what would that trade look like? We might as well walk through it. So just as a reminder, you're trying to capture a couple earnings events, usually on the long side. So in the case of Uber, that means you want to go out at least until February on the long side. So we are going to trade it this way. You might have to wait. The other thing, by the way, is that you could also wait until that weekly is there. So I don't see the that weekly option. Oops. Forgive me. Just send that one to voicemail and I will get back. Okay, so if you were going to put it on now, you'd have to go out to November regular way. If you wait another week, you're going to be able to get... I'm actually surprised by that. Why am I not seeing... There should be weeklies for November 1st. Why am I not seeing them here? Do I have them filtered out? Okay, well, I'm going to do this just by way of example, and then I'm going to figure out what setting I've screwed up in options play such that I am not seeing the weekly options. Oh, whoops. There's the problem. I'm using a ticker symbol that doesn't have them. Well done. Okay, so you will see me make those kinds of mistakes from time to time. Here we go. So we're going to... And by the way, so quick point. It's not the one-day implied move that is going to concern me quite as much if I'm going out. Let's say I'm putting this thing on today with a couple weeks to go. So we can actually gauge the implied move by the end of that week. Stock's about 85 bucks. That straddle is trading about $7, right? So that would be a decent way. Yeah, so a little over 8%. So you could use something like that as your gauge, which is going to be 87 on the high side, and I'm sorry, not 87 on the high side. What am I talking about? It's going to be, that's going to be more like 90, 92 on the high side, 77 on the low side. So that's collecting almost $2 to sell that one. And then we're going to go out and buy longer dated. As I pointed out, February will capture the subsequent earnings. And you'll notice that we don't necessarily have perfect strikes here to make this work. So you could do something along these lines. But this will be good enough. So notice, let me just close this so we can just take a look at the strikes that I've selected here. So for February, I'm using the 95 calls and the 77.5 puts. And for November 1st, weeklies, I'm using 92s and 77s. This is a common thing. February is a regular way expiration. Weeklies usually have dollar strikes in stocks like this. Well, in general, because the weeklies are sort of that trafficked space. So you won't always be able to line it up perfectly, but you don't need to, is the point that I'm trying to make, is that you can get fairly close and it's going to work. One of the things you're going to observe, if you compare this strangle swap, by the way, to the ones that we've often done, is that while it still does have this characteristic that it makes a little bit more money to the upside, which is usually what you'd see when you do symmetric strangle swaps going into events like this, the reason it's not quite is because the upper strike that we're long, in this case, is higher than the strike that we are short. So that's going to diminish the amount of money that you could potentially make, because that longer dated call is going to be slightly lower delta and not profit quite as much. Also, if it runs through that short strike, you're not sort of getting, complete a complete offset. So that's the reason why this strangle swap, for those of you who've seen me do a couple of them, you'll know this one's a little bit more symmetric looking, but that's the way you would do that. So I hope that helps. Next, do you think ELF has found a bottom? It's really interesting. I was just looking at ELF, Ulta, Estee Lauder, all of that over the course of the weekend in a somewhat befuddled way, because I will admit that this is an industry that doesn't make as much intuitive sense to me. I don't know completely what motivates it. And if, my wife was here, or my niece, or somebody else who has arguably a better sense of such things, I would probably ask them that question. Because, Estee Lauder obviously has been very hard hit. And ELF fundamentally appears to have an advantage because they continue to grow. If you can see yeah, you can see. Okay, good. So, this is a not growing as quickly as it did, but still growing. Whereas Estee Lauder had some dips in here recently, as you can see. But the valuation difference between these two isn't necessarily all that insignificant either. So we're going to put them side by side to have a look. And so you can see that Elf is trading, call it 50 times earnings versus 36. And that, by the way, strikes me as pretty expensive, for a company that you're really hoping for them to rebound. I'm just going to take a look at the forward multiples, because this is what really sort of reveals it. And that is that these two businesses are trading at essentially the same forward multiple. Estee Lauder, which has been floundering, shrinking in real terms, shrinking in nominal terms, not even just real inflation terms. I mean, it's year on year, their dollars of revenues have been going down. And to me, the notion that you could buy the smaller growing business for the same turn of forward multiples as the one that isn't makes absolutely no sense. So if your question is, how do I feel about Elf versus Estee? Yeah, it's Elf all day for that reason. Do I think it has finally found its footing? Well, I think that's more of a technical question. I will rely on others to do that, and we can just pull up some of the technical metrics and just see what they have to say. I wish we had Carter on here, and he could probably speak to it. What we can see here is that most of the technical indicators are bullish here. So, kind of take your pick. RSI, which is a more short-term one, basically suggesting that it's, had hit an oversold level. And, the stock obviously caught a nice bid today. So, on balance, the technical stuff that I look at, which is really somebody else's technical stuff, if I'm honest, is would also favor it. And definitely over Estee. So I hope that helps you. Oh, and actually, let's just take a quick peek. When are they reporting? So they are reporting earnings on the 30th, day before Uber. And yeah. All right. So what is next here? Thoughts on shorting Qs via options for the next 3 weeks. Yeah, I mean, there are a lot of people that I talk to also, they just think that we are in this melt-up phase. The economy is stronger than a lot of people had expected that it would be. CPI data notwithstanding, the general view was that inflation was leveling off. But to me, it tends to be more cyclical, because what ends up happening is you have a wave of inflation. Then you have sort of a little bit of a lull as things calm down, but there's pent-up demand for higher wages from labor. And so that's when you're going to start seeing things like strikes and people demanding wage increases. And in many cases, they need it just to maintain their standard of living. And that can create a second wave. And we, in fact, are seeing some of these things. I mean, if you take a look at some of the more recent union disputes, the kinds of wage increases that we've been talking about in many cases are quite extraordinary. Whether it's the longshoremen, whether it was the auto workers, it's, we're seeing requests over, multi-year contracts, granted, but for increases. I think the longshoremen wanted 76% increase, for example. And what ends up happening if you start providing that? And it's kind of like a traffic jam. It seems like it clears up for a second and smooth sailing, and then there's another slowdown. And I think it is a result of the fact that various portions of the inflation picture within the economy do not proceed at the same pace, and you kind of get this accordion thing going on. So I don't know that it's completely over. And so I do think that those that think we're completely in smooth sailing are not right about that. There's something else, which I've talked about on earlier live streams, which is, at some point, and I don't care which party you support, or even if it's no party, I'm, a registered independent myself. But the fiscal problems that we face need addressing. Entitlements need addressing. They are not solvent. And you do not get, as we've seen in other countries that have essentially very minimal real economic growth, and probably most of what they are getting is a result of things like government spending and debt. That's not really all that healthy. And I think that if we start confronting those problems, it's going to have carry-on effects. So, with respect to via options, the bearish, that put spread I was just talking about, which was the November month ending 580.60 in SPY, but something equivalent to that in Qs is probably also fine. I'm not necessarily calling for the market to crash, but, fresh all-time highs all the time, only on the basis of ever higher valuations with rising 10-year rates. So that's the thing, right? So think about corporate earnings yields in the broad market versus 10-year yields, and also think about the cost of capital for those businesses. And you would expect that if those rates start rising, then the corollary to that would be that it's maybe not so great for equities. So not calling for a crash, but that's what I'm thinking. Okay. Steve Garcia, there's a couple questions here about Bitcoin. I want to trade Bitcoin but don't want to buy it or sell it directly. What is the single best ticker to use that tracks Bitcoin index? I'm curious. Yeah, my colleague Mark Guthner, as Brad just pointed out, I would guess that MicroStrategy is going to be pretty close, though. That is my expectation based on their motivations. And let's just take a look. That looks like it tracks reasonably well. R square of 52, but let's normalize this. Oh, it already is pretty much normalized anyway. It's actually proven to be a little bit better than Bitcoin has been. I think that day to day, this one is going to track as a single stock. It's going to be, I think Saylor, he has plans that link very closely to Bitcoin. There's a little bit of a leverage play in there because they took on debt to buy it. But then, of course, they have a massive amount of it on their balance sheet. So, I think MicroStrategy is probably a good candidate on that score. And let's just take a look here. My guess is this thing's probably trading quite a lot of options as well. Look at that, 470,000 contracts today. That would be, in the single stock space, that's not a minor. And by the way, the minors, that's not really, it's kind of, to me, it's a little bit different than actually trading. I think of this more like an integrated oil company is to oil, MicroStrategy, that is, just because, you think about an integrated oil company on their reserves, whereas you think about some of these other businesses on margins. And because they have a lot on their balance sheet, there's Bitcoin reserves, if you think about it like that. So that helps explain the relationship. And John Smith, can you explain forward multiple versus PE ratio? Oh, okay. So, well, they're both PE ratios. That's the first thing. It's just that one is on a trailing basis and one is looking ahead. So when I was talking about this, we were talking about Elf Beauty, and we were talking about Estee Lauder. So I'm going to bring up two sets of financial data. One is looking back, and one is going to look forward. And let's take two different windows to look back. So first things first. Looking back the last 12 months, Estee Lauder made $2.61 a share adjusted. That's this number right here, if you can see my cursor. If you can't see it, you can jot it down or whatever, but just, think about it that way. So on a trailing basis, last 12 months, ended June, all you need to do is you take the existing share price of $9.44 and you divide it by the adjusted EPS level of 261, and that gets you a PE, a trailing PE of 36. Okay? Now this number over here is the forward PE. This is what the company is forecast to make on an annual basis for the 12 months ended June 30th of 2025. So this is next year. So literally going from 2024 to 2025. You can see that's an increase of about 12%. So once again, this is the street's consensus estimate. So you take the forecasts of all of the guys on the street that cover it, and then you average them out. This is the number that you got, $2.90 a share. So you divide that, and lo and behold, you get whatever, 32.5 times, right? So if we go over to Elf Beauty, because it's growing so much faster, so here, once again, $115.43 a share. Trailing number is 229. That gets you to 50 times. But if you look forward, now in this case, notice if you didn't observe it, I just want to point something out here. So this is June to June. This is not June to June. That's June to March, right? So embedded in this is actually one already reported quarter. So actually the way I need to do that is I actually have to break this out into quarters and then go forward by 4 to do that calculation. So now what do I have? I have 44 cents, 89 cents, $1.08, and 112. That gets me to 353. So now 115, 353. So I divide 115 by 353. What do I get? 32.5. Exactly the same number that I got for that same period of time for Estee Lauder, right? And the reason this is important to do is because very often if you see a company that's trading at a really low PE, that is because it's probably a cyclical business and the street's estimates, the forecast for forward-looking earnings, are lower than the ones that just passed. That's usually going to be the case. So companies that have volatile earnings, cyclical earnings, periods when they do very well and mint money, and other periods where they don't make any money or even incur losses, you're going to see that kind of a behavior where they're going to trade at a lower multiple. And you want to try to see, okay, well, what's the street expecting? And in this case, we're basically just taking the consensus. I don't know how good the consensus is, but it's the same analysts who are taking a look, because these things are generally going to be covered by the same people on the street. So that's the overall view. You take all of the estimates of one company, all the estimates of another, and you can compare them and just sort of say, okay, which one is expected to grow faster? Is there a reason or rationale for that? And when you buy a company, you are not buying it for the earnings that the company made in the past, because you don't get that, right? That's what the shareholders who already own the stock got. That's all gone, right? So you buy a business now, that's the only thing that matters, right? So you decide to buy a dry cleaner at the edge of a development that's about to go in. There's no houses there now, but there will be. That's what you care about. Or if you buy a dry cleaner at the edge of a development and all the people that's already been built and has been around for 50 years, and everybody who works, everybody who lives there works at a plant nearby, but that plant's being closed. So you're in Davenport, Iowa, and everybody works at the John Deere plant that's moving to Mexico. Well, that's a problem. So past things can help us identify some trends, but it's the forward number that matters to us a lot more. So I hope that helps. Okay. Let's see. All the other insurance companies are rebounding. Yeah. So Michael Anthony, just on this Elf Estee Lauder, just one final thing. You would be long or like Elf better than Estee. Yeah. If anybody, I can buy them both at 32.5 times. earnings, the next 12-month earnings, only one of them's growing at 40% plus a year, and the other one's finally rebounding to up 12. That would be Estee, right? So you look at the two and you say, I mean, assuming they can keep that outperformance up, they obviously have a formula that is working better for growth. And I want to buy a business that's growing rather than one that is stagnating. So for the same money, and that's essentially what you're talking about. Next year, $1 worth of earnings, you pay 32.5 times that number for either business. But it's not a coin toss because one of them is growing a lot faster. Why is the 10-year rising if the Fed is cutting? The Fed is manipulating short-term rates. They manipulate long-term rates also through the balance sheet. But right now what's going on is if inflation expectations are going higher, then long-term rates are going to go higher. If growth expectations are going higher, then actually long-term rates will also go higher. So that's, it kind of cuts both ways. How do they manipulate the long end of the curve? Through asset purchases or sales. So if they want to keep long-term rates low, then they can just start buying treasuries with impunity. They can, and actually they bought things other than treasuries, right? So they bought mortgage-backed securities and things like that. And so they can manipulate the spread, they can manipulate the curve, and they can manipulate rates. But the rates that we've been talking about, the FOMC rates, we're talking about the Fed funds target rate, right? So that's the short rate. That's essentially the overnight rate. 10-year Treasury rates are separate. And actually, I will say one thing about the 10-year rates that I am reasonably happy with is that they have reduced the size of the Fed's balance sheet pretty materially. Not enough, but materially. I mean, the QE that took place during the pandemic, I think, was inappropriate. What happened during the GFC, the early stages of the GFC, that's a different thing. It's a longer conversation. There's a case to be made. I get that case and kind of agree with it. Actually, again, my friend Mark Guthner, he did a whole presentation about this. Essentially, it was replacement for the money supply that was lost in bad debt as a part of the GFC. So there was a justification to stabilize the money supply. And actually, if you looked at the early stages of QE, it was a perfect offset. So the steady growth in the money supply basically remained consistent through that period. So again, one could argue that Bernanke was on the right track. More recent efforts, though, I'm not on board with. So to see the balance sheet decline is something that I definitely want to see because I want us to have some dry powder. And also, yeah, I mean, it's just undoing bad policy. But yeah, so in fact, actually, I will say this. You lower the short-term rate precipitously, you almost expect the long end to go up in the short term because you are doing two things by reducing that rate. You are stimulating growth and potentially its corollary creating inflation, and both of those would create an increase on the long end of the curve. So this is why a lot of people who are trading rates are, they play flatteners and steepeners. So they're basically playing the relationship between short and long-term rates. That's what they're talking about when you hear guys talking about, steepener was the big trade or whatever. Okay. So, can you tell us why Humana keeps dropping and then rebounding by news on CNBC, and how does the news hurt earnings? So that's the thing. Well, the news, pundits talking about a company don't really impact earnings very much. And of course, there's going to be other. I mean, how much are people really listening to the pundits from real money accounts? Are they really paying attention to, what those of us who are on CNBC are saying to make an investment determination whether they're going to buy or sell a stock? Probably not that much. Obviously, you get some impact from that when news is positive or negative. There's going to be, but that usually comes out in the wash over time. If what the person was saying was accurate, then they were bullish on the stock, then in the long run they'll be right, but not because they said it, simply because they were right about what was actually going on there. Short-term volatility notwithstanding, because of course, sometimes a headline hits the tape and people act first and then dig in a little bit later for safety, right? So if you're a fast money trader, you kind of need to do that. figure out what's going on before you continue on too much more. Okay, so I think we've gotten past all of this ELF stuff at this point. So anyway, on Humana's, well, let's just talk about Humana in general. And I guess, well, yeah, we're getting up to the latter end of the, I want to compare this to United Health, which is kind of my favorite in this space. I don't know why Delta just showed up. Actually, by the way, I'll point this out. A good friend of mine, a former colleague, was saying recently, everybody on the network, he said, why do all you guys on CNBC always talk about Delta? You know, best of breed, this and that. And he was talking about United Airlines, trading whatever 5 times forward earnings, basically having the same dynamic. Love has got structural. Love is Southwest, by the way, has structural problems. I only mention that because I know Jim Cramer was talking about it earlier today. But United, he has a point there. You know, sometimes one of the things you want to do is when you find the best of breed, but it gets to be valued somewhat richly, you say, okay, well, maybe it's a secular story, and I can benefit by being in the cheaper variant. So we're sort of looking at that dynamic right now as we talk about Humana and United Health, that is, United Health. So I was talking about, when I'm mixing things up here, because I say United, I'm talking about both United Health in the context of Humana and United Airlines in the context of Delta. So sorry about that. I probably should have reserved the conversation for different times so I wouldn't create too much confusion. So as we take a look at these, United Health has definitely been best of breed and the outperformer. And if we take a look at the fundamentals, maybe that helps us understand perhaps a little bit of what's going on here. So United Health, we can see very steady, high single, low double digit growth. Actually, Humana's doing pretty well on that score too. Let's see here. What's the multiple on this thing? So here we're going to look at a table that shows us all of these things compared to one another. Actually, Humana does seem like it's pretty cheap, come to think of it. Yeah, maybe you just wait for the pundits to talk the stock down and buy it. Because I'm always looking at United, I maybe haven't been paying enough attention to this. So here again, going to what I was just talking about, we're about to come into the end of 2024. So if you're looking at the multiple to earnings and you're thinking about the $16, which is actually a year-on-year sequential decline, this is essentially all but behind us now. We're in the fourth quarter as we stand. So, you know, if I'm looking at a business like this, the number I care about is next year. And that's almost $20 a share, right? Let's just round it up and call it 1970. And that's 13.6. And let's see what the share count's going to look like. And they've got a little buyback action going on here. How long to complete the program? And when were they buying? So look at this. Um, 2022, late in the year, they really put their buyback program to work. 2023, late in the year, November, that's the biggest portion of their buyback. And then again into January. Cheap multiple, cash in the kitty for buybacks. Looks like they've barely scratched their target amount. So it's 4% completed. It's a 3-year buyback plan. And my guess is, I could be, I'm not going to give you my cynical reason why we see these buyback timings working out the way they are. But Humana, yeah, sure. Why not? 13.5 times earnings, growing top line, very cheap multiple, cash in the kitty for a buyback. And they typically deploy those buybacks late in the calendar year or early in the following. So there's money available, and it's, you know, healthcare typically lower vol. So I think with that, I've answered most of the questions that you guys had for me today, and thank you for putting so many of them in there. And I hope that, you know, whatever I said plus a MetroCard, that'll get you on the subway, but I hope it helps out a little bit for those of you who are interested. Like, subscribe, and tune in again on Wednesday at 4:15. Hopefully we won't have a power outage that delays the live stream. I'll see you then.